Ladies and gentlemen, good afternoon and welcome to the GIC's virtual event on repo market, monetary policy, and liquidity. My name is Bill Kennedy. I am the Chief Investment Officer at Fieldpoint Private and serve on the board at the Global Interdependence Center. It's a pleasure to be your moderator today, and on behalf of the GIC staff and the board of directors, let me welcome all of you to today's call. Just a couple of housekeeping items. Our speakers are going to be referring to slides. If you want to follow along, you can access those slides through the GoToWebinar page. You'll find 2 or 3 PDF files listed. You can click those and follow along at your leisure. Also, the slides will be made available on the GIC's website. That's at www.interdependence.org. Second, today's event is being recorded, and the recording may be accessed later at your convenience, also through the GIC website. Following the speakers' prepared remarks, we will host a brief Q&A session. If you'd like to submit a question to our panelists, please do so by selecting the chat tab if you're on the GoToWebinar, or if you're calling in remotely, there should be a messages tab that you can submit your question. We will collect the questions and try to answer as many as we can in the time allotted. Now, our panelists. Dr. Robert Eisenbeis is the Chief Monetary Economist for Cumberland Advisors, based in Sarasota, Florida. Bob was formerly Executive Vice President and Director of Research at the Federal Reserve Bank of Atlanta, where he was in charge of research and policy analysis and is a renowned expert in global monetary policy. Christopher Whalen is an investment banker and author who lives in New York City. He's the prodigious editor of the Institutional Risk Analyst newsletter, and Chris is an expert on the banking industry, liquidity, and monetary policy. So if there's one thing that whips global markets into a frenzy, it is any sort of bottleneck in the global money market or liquidity system that creates stress that is typically associated with historic funding shortages. On September 16th, almost 1 month ago, the repo rate, which is usually linked to the federal funds rate, spiked to levels close to 10%. The next day, on the 17th, the Fed started injecting liquidity into the system by offering to buy treasuries and mortgage-backed securities overnight from primary dealers. Today, the overnight repo rate is at a much more normal level of about 1.87%. Bob Eisenbeis, before we get into the why of last month's spike in overnight repo rates, can you give the listeners a 30,000-foot explanation of what is the repurchase or the repo market, and how does that market work? Over to you, Bob.
Sure. Sure. Thanks very much, Bill. It's a pleasure to be here. And what I want to do is take a broad look at the events that brought us up to this 10% spike that Bill mentioned, right in the middle, really, of the FOMC's September meeting. We really don't know what happened in the sense of what the triggering event was, why that happened on that particular day. But what we do know is that the bank funding market dried up due really to a confluence of a number of events, some of which are not really known with certainty. However, some have argued that there were stresses for some period of time beginning to show themselves in this particular market, and some of these were due to the fact, for example, that people point to that corporations on that one particular day had to liquidate a lot of securities to make tax payments, which impacted money market mutual funds adversely. And then there was a flood of government new issues that came into the market, and that combined with binding liquidity constraints from a regulatory perspective caused this squeeze. And the squeeze was really on the primary dealers who financed their portfolios of treasuries and mortgage-backed securities in this overnight repo market. If you'll turn to the page 2 of the charts, for those of you that have essentially uploaded the PDF, and I'd encourage you to do that, what I have put here is essentially documenting what exactly the Fed did in this overnight market and in the term market to address these liquidity problems that were taking place. And I'm going to provide a little bit more background in just a second. But what the chart shows is that the Fed initially began injecting funds, 52 billion, then up a little bit more. And you'll see the blue line is essentially what happened up through today. The orange line, the orange bars in this particular chart, show the amount of issuance of term repos that the Fed used to supplement what was going on in the market. And you'll notice they peaked at over 200 billion on September 30th or thereabouts. This was really an emergency kind of interjection of funds by the Fed into this market. And it was really actually a logical extension of some of the policies that actually were put in place during the 2008 financial crisis. So if we turn to the next chart, here's a little bit of background on the market. The current involvement of the Fed in this repo market was really, as I said, an extension of the primary dealer credit facility that it established during the financial crisis, and that was closed in 2010. Primary dealers are a group of some 24 broker dealers. About half of them are affiliated with foreign institutions, and they participate in the daily Fed funds market as well as this repo market. And as primary dealers, they are expected to make and participate in the Fed's open market operations as well as to participate in Treasury auctions. Virtually all of the transactions in this market take place directly or indirectly through the primary dealers. And then, as part of the financial crisis, they broadened access to this market to money market mutual funds when they created the money market investor funding facility in October of 2008. That closed in October of 2009. However, the FOMC established an overnight reserve repo facility as a temporary supplement, an attempt to control overnight interest rates because transactions in the Fed funds market were not essentially helping to meet its objective. So it established a relationship with counterparties besides just primary dealers that included banks of over 30 billion, GSEs, which were basically Freddie and Fannie. Primary dealers were also included, as well as money market mutual funds. Money market funds. They all transact directly or indirectly through the primary dealers. It's important to note that part of the reason for this is because it has to do with who is able to hold funds and deposits at the Fed. Primary dealers are not eligible to hold funds at the Fed. They work through banks, but they deal directly with the Feds. Money market mutual funds are also not able to hold deposits at the Fed and receive interest. But GSEs are, but they can't receive interest. So we have this very complex plumbing that operates in this particular market, and it's a little bit difficult to understand. But against this background, I wanted to sort of discuss a little bit what actually began to happen. So what happened recently? I think sort of simple supply-demand analysis can help us provide some views here and insights as to what happened in this particular market. And the remarks I'm making really draw very heavily on work that was done by Zoltan Pozsar from Credit Suisse, who seemed to have anticipated in his writings much of the problems that ultimately occurred. Now, he didn't precisely identify the date that they were going to, but he did make observations of where the pressures are likely to come from. What kinds of things did he identify? Well, first, it has to do with the supply of treasuries that need to be financed on the books of the primary dealers. And these increased significantly since the Fed started to normalize its balance sheet, trying to bring it back to some level from the 4 trillion that it had reached during the financial crisis. He also noted that the Treasury was on track to issue more than 800 billion in additional treasuries by the end of this year, and increase its balances at the Fed by some 200 billion. Now, data released on Tuesday suggests that deficit's now over $1 trillion, which is 200 more than were previously forecast, which only adds to that number that Zoltan had identified as needing to be financed through the end of this year. So we can see a huge supply of treasuries on the market that were going to be run through the primary dealers, and in one way or another, we're going to have to be temporarily financed until they could be distributed out into the marketplace one way or the other. Now, on the other side of the equation, there were some issues that affected the non-dealer demand for securities, which had declined significantly over the last year. First of all, corporate offshore holdings of securities had declined. Then there was the curve inversion in the yield curve that made treasuries less desirable investments for everybody. Foreign bank usage of the Fed's foreign reverse repo facility, which was an addition to the facility that we're talking about, added volume to the overnight market and reduced bank reserves, since these central banks actually transacted through the primary dealers, and that's ended up sterilizing about 290 billion of reserves that might have flowed into the market to help finance these holdings of treasuries overnight. Overall, it's estimated that dealer inventories have increased by something on the order of 300 billion from 75 billion that they were. While at the same time, demand for treasuries shrunk by about 800 billion. So what we have a situation here is pressure on both the supply and the demand side of the market for these treasuries, which essentially ended up in a bottleneck appearing on the balance sheet of the primary dealers. And finally, since banks would be some of the major suppliers of these funding into this market because of the excess reserves that they had, it's been argued that regulatory requirements, particularly for liquidity, favored treatment of bank reserves held at the Fed, making it costly and more difficult for banks to supply funds into this overnight market to help with this funding problem. So that brings us to it's my last slide here, and that is, so what's the Fed done? And this last chart shows essentially what we saw in the first chart to the left of the green bar. That's the pattern of issuance of both overnight funding in the repo market from the Fed and the term market. And to the right is what they put forward as a plan a couple weeks ago, that they were going to be continuing supplying funds into this market up through November 4th or thereabouts. And so you can see that in this particular case, we're looking at the potential for something on the order of between 175 to well over $200 billion being supplied into this market on a temporary basis. And then on top of this, we learned earlier this week, that Chairman Powell has now indicated the Fed is really working on a plan both to expand its balance sheet, which these transactions do, and create perhaps a permanent facility to help relieve some of these pressures that exist in this particular market. So with that little background, you can see that the Fed actually got caught a little bit by surprise by what happened in this market. It responded by putting in place first a temporary procedure, then a little bit longer term procedure to deal with and facility to deal with pressures in these markets, and now they're talking about a permanent facility in the context of an expanded balance sheet. So that's where we are today, and that's where I think we'll turn the floor over to Chris to make his observations.
Yeah, and Bob, let me ask just a quick clarifying question. You
Sure.
talked about supply-demand imbalance. Are the repo disruptions a function of U.S. Treasury increasing the supply of bonds or the supply of treasuries needed to fund a growing deficit? Maybe you could answer that, and then we'll ask Chris to answer it as well.
Yeah, that's my belief. When you look at the numbers in terms of the deficit, the volume of outstanding securities, all of which have to flow through the primary dealers. And if there's a problem placing those securities out in the marketplace, temporarily they're going to be on the books of the primary dealers. That needs to be financed. And so this is really more than anything in my own mind due to the unintended consequence of, when I mean unintended consequence, the need for these financings weren't anticipated because of what the Treasury was doing. Maybe they should have been anticipated, but I think that this is a Treasury supply issue.
Chris Whalen, your view on that question?
Well, thank you, Bill. Monetary economists will often tell you that Treasury issuance and monetary policy are completely divorced. But I think the size of the Treasury's issuance is kind of begging the question. We've seen stress since last year, and I think the assumption that we would always have enough liquidity to float the Treasury's needs and take care of everything else has been challenged.
Great. So, Chris, we'll turn it over to you and your views.
Well, thank you, Bill, and I appreciate the invitation. If you look at slides 5 through 7 in my PowerPoint, what we see is basically the progression of stress from last December in 2018. You can see the relative magnitude of the stress in the first slide going back to the financial crisis. And then 2018 was very specific because we had a liquidity crunch at the end of the year. The Fed was still raising rates. They were running off the balance sheet. And the combination of these two factors really caused a problem. New securities issuance dropped dramatically in December. And even after we got into 2019, we continued to see a choppy, disjointed market in federal funds and repo that normally you don't see. These are fully collateralized short-term markets that normally trade on a couple of basis points at that. And as you said, Bill, in your introductory remarks, we saw rates spike orders of magnitude in a day. So this suggests that there was something particular, something idiosyncratic at work that's normally not seen, to Bob's point. And we're not quite sure what it is, but I'm affiliated with a good-sized broker-dealer in New York, and we trade repo. And when you see a 2 or 3 or 4 point difference between the price that the primary dealers are getting from the Fed and the price everybody else is getting in the secondary market, that indicates that there's a problem, because investors and broker-dealers who cannot finance Treasury securities and agency securities efficiently just won't hold them. And that's why this is such an important issue for the FOMC, because when they say the rate for Fed funds is 1 3/4 to 2, it's incumbent on them to defend that range. Because if they're not credible, and if dealers don't feel that they can reliably access liquidity, then you end up with a big problem. The other very important point that Bob made was the supply of treasuries. As the Fed has reduced their balance sheet, large banks have tended to hold treasuries and Ginnie Maes instead of excess reserves in order to fulfill their liquidity requirements. You don't have to hedge excess reserves. They always trade at par. Whereas a treasury or a mortgage-backed security has volatility and it has price risk, which the banks have to account for in their calculations for their own risk metrics. And regulators in turn look at that and they want to see the banks hold more liquidity than they did before the crisis. Now, we saw over the summer in July and August, a number of big banks who are normally the marginal providers of cash to the market step back. Jamie Dimon at the Barclays conference basically came out and said that he was no longer going to be the marginal provider of cash in the short-term markets. And so I think there is a structural problem here with prudential regulations that conflict with monetary policy. And how we deal with that, the Fed board is going to be making some changes this week for large banks, but I think it requires further study. And just, my last point is that I think we run the risk of seeing a repeat of last December this year. I think the Fed is going to have to be very vigilant in terms of the year end because many banks are going to close their books after Thanksgiving and they're just not going to take more risk. And I also think, going back to Bob's point about the financial crisis and money market funds, whatever solution the Fed puts in place to ensure that there is a liquid and continuous market in Treasury securities, which includes overnight financing, term financing for 2 weeks or even 30 days, it ought to be open to all financial institutions because the conflict in prudential regulation raises the question of whether or not large banks can serve as a reliable conduit for liquidity, especially in times of stress. Because right now the regs basically say to big banks, you're an island, prove to us you can last for 30 days without going to the markets. Well, all of us are the markets. And if the banks are going to essentially hoard their liquidity, then the rest of the market's going to have a problem. And I think this is a very tough issue for Chairman Powell and the other members of the FOMC. So I'll stop there, Bill, and maybe we can do some questions.
Great. Thank you, Bob, and thank you, Chris, very much. Again, for those of you who want access to the slides that Chris and Bob were referring to, those should be available on the dashboard. However, if you want to access them, go to www.interdependence.org, go to the resource section, and you'll find the slides available there. Again, if you'd like to ask a question, please submit through the chat on the site. And while we're waiting for a couple of questions to come in, let me just kick off. Chris, I'll put this one to you. There's been much debate about whether the Fed's repo market liquidity injections represent quantitative easing, or some have suggested QE light. What's your view? Is this actual QE that we're seeing to address what's happening in the repo market?
Well, it's funny. The Fed is kind of caught on the horns of a dilemma. I'll be fascinated to hear Bob's comments on this, but the phraseology that they use to describe quantitative easing has now put them in a bit of a bind. So any adds to the balance sheet are now called QE. I think what they're doing is putting back what they had taken away. And, people often don't understand that when you expand the balance sheet at the Fed, you're also growing bank deposits because the Fed is essentially subsidizing the Treasury's issuance. And so when eventually that Treasury bond is redeemed, if the Fed is not continuing to grow the balance sheet, then bank deposits fall because the Treasury has to go out and refinance that bond and a bank deposit disappears. So when they were shrinking the balance sheet at an 8% annual rate, that was a lot. And I think what we found out, kind of to use a fishing metaphor, is that they lowered the water in the lake so much that we could see the rocks. And when we have to start talking about tax payments and corporate payment activity in this vast market for payments that underlies the US economy, then you know you have a problem, because normally we don't have to talk about particular items in that market, and that tells you that we had a little problem.
Bob, anything to add there?
Yeah, I'd like to make two observations. First of all, banks aren't really faced with the choice of holding reserves or government securities. An individual bank may be, but reserves, if a bank decides to buy government securities rather than hold excess reserves, those reserves just get transferred to some other institution. So reserves never disappear and shrink as an alternative from the banking system perspective as a whole. So they're going to be there unless the Fed starts to shrink its balance sheet, which it did, and we saw that reserves in the banking system declined commensurately. So it's important for us to sort of understand that a good bit of what the Fed was doing, if you notice, between the time that it started to shrink its balance sheet, government securities held by the public increased by about $1.3 trillion. What a lot of people don't realize is that because of the way the government accounting goes, securities held by the Federal Reserve count as securities held by the public. So we know that the Fed shrank its balance sheet by some $500 billion, and yet securities held by the public went up by $1.3 trillion, which means that on net, securities held by the public outside the Fed went up by even more. That's a huge increase in financing needs for the public as a whole and for the Treasury.
Great, thank you, Bob. One question someone has asked is, given the Fed's repeated intervention in the repo market, isn't this just a sign that the Fed is incapable of forecasting anything? They're suggesting forecasting the volatility in these types of yields and these types of rates. Bob, you want to take a crack at that?
Well, I mean, if you see the volatility, then almost by definition, you've answered the question. Yes, they've had difficulty in financing and estimating. I think part of this has to do with just the nature of the operating procedures. At the beginning of the day, they have to try to guess how much funding is going to be needed in these markets. And they could solve that problem easily if they engaged in continuous transactions during the day. But trying to guess means that you're going to make errors one way or the other, and they just haven't been able to do it in such a way to anticipate in the morning how much funds are going to be needed through the rest of the day. So I think a lot of it has to do with just the nature of the operating procedures, and this one, as Chris has suggested already, the reliance primarily on these so-called primary dealers, as opposed to opening up some of these markets to a broader range of counterparties. There's no reason they couldn't operate the way the ECB does, dealing with over 500 counterparties, commercial banks in Europe. There's no reason, given technology today, that the Fed couldn't do something similar to that.
Okay. Chris, this one's for you. Reading between the lines, it seems we're on the verge of the Fed indirectly financing Treasury deficits. This sounds like a modern monetary theory type question. And the person would like to know, do you think that's a fair conclusion?
Well, I think it is. Look, the assumption in the United States, going back to World War II and Bretton Woods, is that the dollar would be the leading reserve currency. And I think the assumption on the part of US officials is that there would always be enough liquidity for the US Treasury to operate and to issue debt. Now, if you think about Bob's comment about the difficulty of managing this, you then throw in another factor we haven't mentioned, which is the dollar. If the dollar is strong, then foreign buyers of treasuries tend to step back because the risk is too great and the yield on the bonds is so low that the threshold for making that buy decision is very difficult because they want to hedge their dollar exposure when they buy the treasuries or buy the Ginnie Maes. So it's impossible really for the Fed to be able to manage this. And this is a legacy of the board's decision several decades ago to target federal funds, which was, remember, a private market. I think the Fed ought to think very long and hard about changing the way they pursue the dual mandate and perhaps de-emphasizing Fed funds as a specific policy tool, simply because I think it's unmanageable. To have enough liquidity in the market, they can do that. But to essentially predict price and defend that target range for Fed funds every day, given the enormous number of factors involved to understanding the net inflows and outflows, I think is very difficult, Bill.
Bill, can I add just one thing to
Yeah, go right ahead, Bob.
Chris's comment, and that is approximately 30% of the reserves held at the Federal Reserve are owned by subsidiaries of foreign institutions. Now, if you're a bank and part of a holding company organization in Europe, you have the choice of either holding funds at the ECB and receive a negative interest rate, or holding reserves at the Federal Reserve at a positive interest rate. That's a risk-free arbitrage that's playing out here, and it particularly since deposits held by a foreign bank at the Federal Reserve counts towards the Basel III liquidity coverage ratios, makes this a very desirable investment. And in fact, if the exchange rate goes up, they make money on the return. So there's another dimension that just makes this even more difficult and complex to fully get one's arms around if you're a policymaker, which is what Chris's point was really all about.
Okay, we've got 3 more questions and then we'll wrap it up. Bob, this one's to you, very easy. How big should the Fed's balance sheet be?
Well, that's an interesting question. We don't know. And ultimately, I think what my chart, the last one I had, showed was that the Fed is actually running an experiment to see how large the balance sheet needs to be, a combination of term versus overnight money. And if you'll notice in the chart up through today, they stood ready to issue on the order of as much as $75 billion on a daily basis in the overnight market, and that's fallen down quite significantly as the volume of term repos has increased. So clearly, I think we're looking at let the market determine what the size of the balance sheet's going to be relative to the ability to hit those target rates that Chris was talking about. So I think they're sort of play as you go, as opposed to having some idea in advance as to how big this market has to be.
Well, precisely, Bill, but that means that the market's in control and that the Fed really can't set the size as a matter of policy. Because if the market needs funding, they're going to give it to them.
So this may have answered a question, Bob, that came specifically for you as to why and how the public is holding funds away from the Fed.
I guess I'm not sure that what's meant by holding funds away from the Fed. The Fed's balance sheet is determined by its policy and how many treasuries it has on its balance sheet. So it has total control over the size of its balance sheet.
Okay. Chris, this is specific to something you said about JP Morgan's comments at the Barclays conference. Did Jamie Dimon give a reason for why they were stepping away from being the marginal cash provider?
I think the question he was answering was in reference to the liquidity coverage ratio, which is calculated by all the big banks now to show regulators that they have enough money to basically get through 30 days without going to the market. But to Bob's earlier comment, if somebody like Wells Fargo, who's holding 10% more liquidity as an institution than JP Morgan is, if they decide not to give cash to the market, this is a problem because that's an extremely big bank and they also have an awful lot of collateral. So if both of those aspects are withdrawn and the market cannot access either cash or collateral from that bank, it means that we have a liquidity problem or less liquidity. But what Jamie Dimon was essentially saying is that we stand the risk of repeating December of last year again. And he said specifically that there was going to be tightness as we went into year end. And, frankly, if you look at my charts in the back of the deck, I'm showing you the GCF repo. That's not the repo of primary dealers that face the Fed, which is separately released by the Fed every day. That's the broader community of broker-dealers that use that contract to move liquidity and collateral around very efficiently. So there have been days in the past few weeks when there was a 20 or a 30 basis point difference between the execution that the big banks were getting facing the Fed and what customers of broker-dealers were seeing from their own counterparts. That's a tiering issue that is very significant. And I think that, again, who knows how big the reserve should be, but I would say that the central bankers cannot just think about reserves. They have to think about cash, and they have to make sure that they're in contact with other counterparties away from the primary dealers to really understand what's going on.
So, Chris, this will be your last question. It's actually two parts. It's based on something you just said. Is there any likelihood that LCR or the liquidity regulations on the U.S. banks could be altered or changed if we continue to see disruptions in the repo market such as this?
Well, I think the board is already considering some changes that Vice Chairman Quarles has been working on, and I applaud them for doing so. After the crisis, we put in place a lot of specific measures that were designed to prevent the liquidity crisis of 2008, but I think in a lot of ways it made it worse. The answer of regulators over the past 30 years, every time there's been a liquidity crisis, has been to reduce liquidity. And I really urge them to rethink this because there's no reason for these large banks to have to keep as much liquidity as they do now. These are money centers that move payments around and mortgage payments and taxes and everything else. And half of their transfers are internal. They don't even have to interact with the rest of the world, but we can't have a marketplace, a bond market and an asset-backed market that is going to function properly if we turn all these banks into islands, because that's where the money is. Very simply, Bill.
And in the same vein, do you think the Fed will look to target SOFR as an expression of monetary policy instead of Fed funds, or will they eliminate IOER? In any changes like that you're seeing, Chris?
Well, I think both Zoltan Pozar and George Selgin at Cato have done really good work on this. The board has been experimenting, as Bob said, with different methods for managing this process since they started quantitative easing. And I think that overall, the experience has been so-so. We really don't, you can't say it was a complete success. So my hope is that they're going to move to something that is a little bit more flexible and that looks at both the ceiling and the floor for the Fed funds target. But I really would wish there was an alternative way for us to pursue full employment and price stability without targeting Fed funds, because the SOFR rate is going to become the de facto rate for all sorts of market transactions. And if the Fed can't assure that that rate is stable and that it's not going to be subject to big swings, then how on earth are we going to originate 30-year mortgages? That market has been whipsawed over the past year. And I can tell you, third quarter earnings for people who own mortgage servicing assets are going to be dreadful because of the rally in the treasuries. People sold those bonds to dealers, as Bob pointed out. They took their gains. So now the street is up to its ears in paper. And everybody who owns servicing assets, which are a negative duration asset, are going to be writing off billions of dollars in paper losses. So, we don't need this volatility. If there was one message I would leave with everybody today, is that we've got to get these short-term markets to calm down again, because it's very disruptive to the economy when you impose this kind of volatility on counterparties, especially non-bank counterparties.
Bob Eisenbeis, final word to you. The questioner has a presumption, I would say, that there will be a recession in 2020, or the potential for a recession in 2020. And the question is, if we continue to see the liquidity and money market system gumming up and volatility in the repo market, could this transmit into an acceleration or deceleration of economic activity?
Well, I think we've seen a little bit of slowing in economic activity. We've seen employment and hiring slow down. One of the things we know about recoveries and expansions is that they tend not to die of natural causes. There's usually some sort of policy mistake that happens. And a lot of the unrest and concerns that the Fed has been trying to grapple with just recently have to do with what they have labeled as uncertainties. And here we're talking about uncertainty about what's happening in the global market. We've got, obviously, political uncertainties now because of just look what's happening in the Middle East. We don't know what impact that's going to have. And there's also uncertainty with regards to the trade policy. As an economist, we tend to draw a distinction between uncertainty and risk. Uncertainty is when you don't know and can't estimate what the probabilities of different outcomes are likely to be. Whereas risk, you at least have some idea as to what the probabilities of particular events occurring. I don't know of any theory that says that changes in monetary policy can address uncertainty. So the Fed is really caught at this juncture between a rock and a hard place. And I personally don't think these liquidity issues that we've been talking about will necessarily generate a recession. I do think it's these other events that are on the horizon that we just can't estimate how they're going to turn out. And that's the problem when you're a businessman trying to make decisions. You're probably better off sort of waiting and seeing rather than putting on more jobs or whatever, making these kinds of decisions that will essentially push the economy forward. So getting rid of uncertainty is the key, is my bottom line.
Great. Bob and Chris, thank you very much for your time today. For all of you participating on behalf of the GIC, we appreciate your time and attention and support, and look forward to our next virtual event in the coming months. Thank you, everybody.
Thank you.
Thank you.